All right. Hey, I'm here with Rohit Agarwal of Sora Finance. Rohit is a good friend of mine and has been running a fintech company that helps advisors like me help my own clients with their debt management. And we're going to talk a little bit about how Sora can help and how to think about debt as a part of your broader wealth planning. So Rohit, thanks for being here.
Yeah, excited to be here. Thanks for having me too, Shar. And it's been wonderful working with you.
Yeah. So Rohit, let's dive right in. Can you give our listeners a quick breakdown of what Sora is and how you can help save them some money?
For sure. Yeah. So in a nutshell, what Sora does is we help advisors manage the liability side of their client's balance sheet with the same level of rigor that they manage assets. So what does that mean for an advisor? One, we're monitoring all of your existing liabilities, whether it's mortgage, auto loans, student loans, or even if you're a business owner, your business working capital loans, SBA 7A loans. We're constantly monitoring them and saying, can you ever save money? So for example, potentially, do you have a HELOC that might be at prime plus two? We'll alert you or alert your advisor if you can move that into a prime minus one. Whenever you can save money on any of your existing debt, Sora is able to do that. The way we're able to do it is we pull in all your existing liabilities at a granular level, interest rate, monthly payment term, in a pretty seamless way, working with you and your advisor. Second way we help is we have 50 plus lenders on our back end. So if you have any lending need, whether it's a new mortgage, whether it's a refinance, student loan refinance, we can scan our 50 plus lenders to get you the best pricing. So you're never paying what I often say an extra dollar of interest to banks or lenders.
Sure. Great. That's really helpful. And to our listeners
Mhm.
who are watching this, I've had the pleasure of using the Sora tool and it's really easy. It's basically like a kind of like a mint.com dashboard that I get that shows me all of my clients' loans in one place, the interest rates that you're paying on it, and if if I as your advisor can see that you're paying a much higher rate, that's a conversation that I can surface with you and see if we can save you some money. But Rohit, in
Exactly.
your year or so
Yeah.
of the company, are there any areas of debt that you find people tend to neglect, and how do you suggest improving them?
Yeah. Great question. So what we see with if I look at kind of existing debt versus new debt, is how I often think about it. And to Shar's point, he has the dashboard with all of the existing liabilities. We also know credit score and income, which is what you kind of need to scan to see what are you available for to get the best pricing from uh, all the lenders on the back end. There's 10,000 lenders in the United States. The debt we've seen people struggle with, I think it is combined. A lot of the loans we have done in 2023 have been new loans, just given rates have been rising. There hasn't been as many refinancing opportunities on the table. We think there will be a lot of refinancing as rates come down, whether it's two rate cuts or three rate cuts. So, for example, if you took out a mortgage in Q4, you'd likely can refinance this summer and save a decent amount of money. On the new loans, we've seen a lot of value just showing that here's what you save if you get a great deal. So that could be, I think we've seen a lot of actually second homes, so investment properties or vacation homes, and trying to get you the best rate on those. Two, a lot of people still buying cars and deciding should I finance or pay cash. I think Sora adds a lot of value telling you here's the best rate on a new auto loan if you want to finance it, which often is better than what the dealer is offering you. HELOCs have been a really popular product for a lot of clients. HELOCs and securities based lines of credit. And I think on the HELOC, we've really scanned to unsurface the best rates for a HELOC and the best terms, whether it's 80 or 90% loan to value. Our most popular product this month or last 2 months has actually been for business owner clients, for folks that want to refinance if they have an SBA 7A loan or a working capital line, because one of our partner lenders is offering a Sora exclusive partnership where anyone coming from Sora is getting a 3.99% rate on their working capital line or their SBA 7A loan for the first 12 months.
That to me, I think is really value add because oftentimes for my clients who are business owners, they have their personal debt management, which might
Yep.
be a traditional bank, but that bank may
Mm-hmm.
have difficulty underwriting the business debt, and so they've got a bunch of different
Mm-hmm.
players working on their
Mm-hmm.
debt. Sounds like with you guys, it's really, you're kind of the one-stop shop, and you can shop it across the lenders, but be the primary point of contact for the client.
Exactly. We want to monitor monitor all of it and try to find, we're running constant algorithms and analytics based on what are the rates all these lenders are offering based on your profile, what are the business cash flow or your individual profile in terms of your credit score, your income, to say, is there an opportunity to save money? I think the other thing we've seen advisors use Sora for is like, hey, I want to be alerted if I'm looking at buying a home in the next 6 months. Can you let me know when my profile qualifies for an interest rate below, say, 5.5%? Like I want to, rates are too high right now, but if they come down to 5.5 or 5, and we can alert your advisor to say, hey, this person qualifies, and Sora is also able to do the pre-qualification letter.
Okay, see, that's interesting. I didn't even know that, so I'm learning something. All of our
Yeah.
listeners. That's awesome. But Rohit, going back to kind of like the the
Yeah.
traditional bank channel for loans, like what are the natural inclination for most people is like, oh, I'll just go to my bank when I'm ready for a mortgage. I'll go to my bank when I'm ready for a loan. What are the benefits of working with someone like Sora versus a traditional bank, and where do you guys kind of sit in the lending ecosystem?
Yeah, no, for sure. So I think there's two main advantages to using Sora. It's one, the data aggregation and monitoring and the alert to your advisor to say, hey, you should talk to this client about this opportunity. But two is just because of the breadth of rates when you have enough lenders in the United States. So if you go to Bank of America or whatnot for a mortgage, that's just one lender and what they're willing to price. We would take that to 50 plus lenders. And on any given day, the difference between the best rate and the worst rate, let's take mortgage, for example, is about 266 basis points. It's almost 3%, which is a significant amount, say on a $700,000 mortgage or $500,000 mortgage. So I think the main benefit is that we scan big banks, community banks, small banks, credit unions, and wholesale lenders to try to get you the best deal.
Okay, got it. And tell me a little bit about your work with the Twin Peaks clients so far. You've had the pleasure of talking to some of our clients. I'd love for you to kind of highlight the benefits of that Sora provides to Twin Peaks clients, and what advantage they can take from you.
Yeah, no, we have obviously really loved working with Twin Peaks and you and your team. I think the main advantage we've seen is probably threefold for your clients. I think one, giving you insight into better data about your clients and how their liabilities are part of their overall financial life. Two, we've done a decent amount of mortgages together, and I think you've seen in action kind of the scanning of lenders to get the best deal for your clients or for Twin Peaks clients. Same thing with HELOCs and a decent amount of HELOCs, and I think third, also scanning for one of your business owner clients that was looking to refinance a working capital line. Say, hey, here's where the rates are if they wanted to act on this to refinance. So I think it's been a combination of data insights for you and your team, plus executing loans with the best rate out there.
Got it. All right, so I'll wrap up with a couple of last questions here. The main thing that my clients have on their mind right now is that rates are so much higher today than they were over the last year or two. What opportunities do you think this presents for borrowers today, like versus how things were a couple of years ago, and how can people think about their overall debt load?
Yeah, it's a great question. We see on our software, there's, we got about 15, 20,000 clients, and the average mortgage rate on our software is 4.4%. Obviously, the average 30-year fixed right now is about 6.7%. If you were to look at today, it dropped a little bit a month or two ago, but now it's climbed back up due to some recent CPI prints. I look at it this way. I would say, if you have the ability to, prices have fallen in certain areas. So you could take advantage of that maybe from a vacation home or an investment property if it was part of your overall financial plan. Two, I would talk to your advisor about, hey, we're thinking about moving. You look at my family, we live in the city in San Francisco, but we're thinking about moving to the suburbs if we can find a rate that's appropriate. So talk to my advisor, be on the lookout and look at, hey, when rates maybe are between at 5.5%, that makes sense for our financial plan. Like we can afford this monthly payment for that amount. So I think to prepare, what is it you're willing to pay for what house if you're looking to move? And then I think third, HELOCs have been popular in this higher interest rate environment. But fourth, we do have a bunch of folks who took out loans in Q3 and Q4 last year, whether they're business loans or consumer loans, that will be primed to refinance, I think, in about April or May this year once the first rate cut goes through.
Okay. Help me understand the HELOC piece, because I've been seeing a number of clients take out HELOCs over the last 2 years as their homes have built up. For HELOCs, I think that, again, the natural inclination is to go back to the same person who gave you the mortgage. Why should they consider you guys this time around?
Yeah, I think on HELOCs, the rates vary even more. So let's be concrete, right? If you want to go, say you have $500,000 of available equity in your home, that gets you up to 80% loan to value, and you say, hey, I want to tap the HELOC for liquidity. It might be I want to pay for college, or I want to improve my backyard. I don't know, put in a deck or something. So I need $100,000. Let's say I need $100,000. If you use Sora, or let's say you go to Bank of America, you're going to get prime plus 1 or prime plus 2. That's right now, prime is 8.5%. you're going to pay 9.5 to 10.5% on that. With
Yeah.
Sora right now, we have partners doing HELOCs sometimes with intro rates. Say you only need the money for 12 months at 3.99%. Not
Wow.
significant. After 12 months, it does float up to prime -1, so 7.5%. But I think the main benefit is we can tell you the best rate on that HELOC and try to get better teaser our intro rates for the first 6 to 12 months, which I think is the ideal scenario if you need to use it for a short period of time. And as another tool to compare, one thing Sora also helps with is if you wanted to use a securities-based line of credit as well. Last thing I did mention, particularly with I think some of your clients that tend to have decent equity holdings often with their employer, is we can scan lenders that will give you credit for some of your non-liquid equity, depending on the potential to a liquidity event. So obviously, if it's a Series A startup, not as much. A lender won't give you as much kind of credit for that. But say you're at I don't know, Stripe or something, you'll probably get some credit for that because the liquidity event seems near.
Okay. Well, we do have a lot of clients at Stripe, so that's good to know.
That's right. That's right. Or like Instacart. Yeah.
Yeah. Well, Rohit, that teaser rate thing is compelling to me because that's, potentially saving 3 to 4% for someone who might only need a short-term loan. That's huge, right? On even a couple $100,000 HELOC, that's, $6,000 to $8,000 a year of interest savings. So that's awesome.
Exactly. That could be invested, take that over 30 years. Yeah.
Yeah. Well, thanks so much for taking the time to speak to our listeners. If someone wants to get in touch with you, what's the best way to get connected and look at some loan options?
Yeah, you can always, contact you as the advisor, or you can always send me an email at rohit@sorafinance.com, or our entire team. We're a fast and growing team. We'll respond to any email at lending@sorafinance.com. So
Okay,
lending@sorafinance.com, probably the best one.
Awesome. Thank you so much to our listeners. If you'd like an intro from us directly, just let me know. I'm happy to make an email intro to Rohit and his team. They do fantastic work. This won't be the only session that I'm doing with Rohit to talk about debt management. So stay tuned for future discussions. Thanks so much for being here, Rohit.
That was awesome. Thanks, Tushar.